name's Jeremy Green, Director of Advanced Planning for CBS Brokerage. Today I'm going to discuss a technique called the installment sale to an intentionally defective grantor trust, or IDGT. The technique is used with business owners who have federally taxable estates who wish to transfer assets off balance sheet without the use of lifetime exemption. For those of you in the wealth management business or who do high-end life insurance work, there will also be opportunities to demonstrate skill, expertise, and concern for clients while also generating new business. So one of the things we want to cover really quick is why do sales versus a gift? Gifting is pretty simple, right? Well, any gift you know that you file, any gift over $15,000 has to file a gift tax return. Anytime the gift tax return is filed, any dollar above that amount reduces the lifetime exemption dollar for dollar. When you increase the lifetime or decrease the lifetime exemption, you also increase the taxable estate. When you increase this taxable estate, you increase the estate taxes. So really what have you accomplished with a gift is you really don't win on the gift itself, you win on the future appreciation you got off the balance sheet. Well, that can be achieved with a sale without using the lifetime exemption. So when you sell an asset, you get something back, the payments for those assets, and really just the future appreciation gets off the balance sheet without the use of lifetime exemption, as I said. And you also get control of the principal the grantor does, and also the grantor may actually wish to get something in return for something as well. So that's reasons for looking at a sale. Now, a sale can cause problems too, except when, especially unique situations where maybe you could sell something to a trust, for example, and not have to pay the tax on that sale. So we could do all the things I just said without the downsides of paying a tax. Now, business owners typically have depreciated most of their cost base out of the business, so that's very important that we consider that. So I'm going to demonstrate a technique that allows us to sell something without creating the tax of the sale and achieve the objectives I mentioned. So very simply, this technique is very basic in the sense that we're going to transfer an asset to the trust. Let's say it was just $1 million for a round number, okay? And we're going to get a note back for that same $1 million. And we also have to pay ourselves an interest rate that the government says is called the AFR rate. And that rate is 1%. And the only question is, can the assets that we sold and transferred to the trust beat that 1%? In other words, by income or capital appreciation or some combination. And if it does, that means that leftover will accrue inside this trust to the beneficiaries of this trust. Okay? Gift and estate tax free. So now I'm going to show you a real life example of that transaction. So first of all, in real life, the client probably has, if they have a federally taxable estate, they may already have a trust. For example, they might have an ILIT or any number of things. And the question is it intentionally defective already? If it is, we can enter into this transaction simply selling something to an existing trust that is already funded. It has to have economic substance in this trust otherwise be a sham transaction. No one would sell something to a person or an entity that didn't have any money to pay it back, right? And the IRS knows that. So effectively, we have to at least have 10% of the transaction funded in the trust as seed money, they call it. So in this example, I'm going to pretend that we have to set up a new trust. But if a client did have a real trust already, CBS would help you. We would review that trust document to identify if it already is an IDGT, and we should work with that. Otherwise, alternatively, we can take an existing trust that isn't an IDGT and make sure that we could administratively add certain powers to make it an intentionally defective grantor trust. What I'm talking about here is administrative trust modification. But let's assume now that we're setting up a new trust, and we're going to fund money into it so that it has economic substance. In this example, we want to do $8 million transaction. So $8 million of business interest. We're first going to seed 800,000 of it, and we're going to take $7.2 million and sell a note for a note into this trust. So $7.2 million of business interest for a $7.2 million note. So we're getting back what we put in, no gift. And we need to pay ourselves back that 1% I talked about. That's $72,000 of the $7.2 million note. So $72,000 when the trust is producing, I assume here, $640,000 of income. So that means the difference between that 640 and 72 is available to accumulate inside that trust to do any number of things. We could have assets under management we're going to manage. We could buy life insurance, and let's just look at what that would do if we did buy life insurance. We could take 200,000 of that and buy an $11 million death benefit. So we have leverage on top of leverage now. This first part of the transaction saved the client's money on estate taxes. We should always look to reduce the taxable estate first and reduce the taxes that we can, and then secondarily find a way to pay for whatever's left. But in this example, I estimated that we've saved $3,200,000 on estate taxes just from this first part of the transaction. From the accumulation, there would be $7.2 million of assets, either shares of the business or actual cash accumulated in here. I mean, if anything else, we simply take the shares we sold here and pay ourselves back. You can pay the note back in kind, and just have accumulated the income in here, and that would do that. And that's how we get $7.2 million of assets at a 40% rate, it's about $3,200,000. I'm sorry. And then we also leverage some of that money to buy a life insurance policy. Now, this is a great technique, right? What I just showed you, for an exit strategy for premium financing too, for those of you who do any kind of insurance work or who run into a client who has that situation going on. When you do premium financing, you basically have an insurance policy here that is taking loans instead of sales to a trust to get around the lifetime exemption use. And there's usually the collateral inside that insurance policy is being used to eventually pay off the note, but that may not work, and that's not recommended. You should have other ways of getting funds in there to offset the collateral requirements the client has, and this is certainly one of the best techniques for that. Now, there is a downside to this transaction we have to consider. I wouldn't call it a downside, but a risk. The assets that the client sold, the reason why it wasn't taxable in the first place is that the tax ID of this trust ultimately flows back to the grantor. So it does have a separate tax number. There will need to be a separate tax filing for that trust, but it will flow back to the grantor. So in other words, he sold an asset to himself effectively, and that's a non-taxable event. That's why there's no tax on the sale or the interest payments to the grantor, because he's effectively going to pay tax on the income of the trust anyway, as if it was on his balance sheet. So think about that. All the business interests retransferred, he was paying tax on before he did this transfer. He maintains the tax liability of this trust. So he has to have, or she has to have, the wherewithal to pay the taxes from this trust without the cash flow from the trust, okay? So you do need somebody who's got the economic wherewithal to do that. Now, if for some reason that's not tolerable over time or doesn't want to, if there's a home run hit, let's say we transferred $8 million of discounted valuation. By the way, when we transferred these shares, we got a valuation discount on that $8 million. It was really $11 million in fair market value. And that, right here we go. And that's true because you get discounts on a transfer of business for lack of marketability and minority interest. So we're assuming there's a minority interest here. So even on the transfer initially of the business interest at a 30% discount, we already won against that 1% interest rate. So there would be a remainder in there. Excuse me. So let's go on to what powers make this not taxable? How do you know if it's an intentionally defective grantor trust? There's about 16 different powers that can make something either partially or wholly intentionally defective without getting into the weeds on that. But I listed 3 of them that are very popular. That's the ability for the grantor to swap assets with the trust items on his balance sheet. This is actually very useful because for cost basis planning, we might want to swap assets in the trust so that we get a step up in basis on items in his balance sheet. So if he sold something on his balance sheet, now he has a high basis, he might want to swap something for a low basis in the trust and continuously do that. The ability for a non-adverse party to add a class of beneficiaries, and the trustee ability to loan money to the grantor without adequate security. There's some powers that we would add that don't impact its IJIT status. One of the things that we would you should always add the ability to surrender these powers so that we can turn off the taxation to the grantor. And that provides some flexibility down the road should he or she decide that that's kind of not something they want to do forever. Also, we could make a spouse a permissible beneficiary of the trust so that the trustee has broad discretion to basically unwind this whole transaction and bring the assets back to the grantor's balance sheet if they would choose to. We use mind mapping software as a project manager software to coordinate and collaborate with you, your accountants, the attorney, whoever, and kind of manage the project if we want us to or not. It's just something that's available. And also, if you have any cases, we'd love to work with you. Here's our telephone number. You can also email me at jeremy@cbsbrokerage.net. Thank you for watching this video. Hope to hear from you.